Welcome back to MrWebProfessor.com's Personal Finance 101 course. In this lesson, we'll be talking about a budgeting overview. Just kind of an overview of what a budget is and how it works. So let's take a look at the agenda. First of all, we're going to look at income, expenses. And when we talk about expenses, we're going to talk about fixed expenses, required variable expenses as well. So 3 different categories of expenses. And then we also look at a monthly budget as well as an annual budget. So what is a budget? Well, first of all, a budget is a plan. It's something that helps us plan for the future and control our spending. It's a measure as well. It helps us to measure how much we're going to spend. And as I just mentioned, it will help us to monitor and control what we spend if we use it appropriately. Finally, it's a benefit because as we use the budget to plan what we'd like to spend, measure what we are spending, and monitor and control our spending over a period of time, then it should result in the benefit of a better financial future. So the definition of a budget is a plan that is usually written to ensure proper use of money over a specific period of time through a system of monitoring and controlling that leads to a specific result known here as the benefit. So what are the parts of a budget? Well, some of the parts are income. And when we look at income, we're going to look at planned income as well as actual income. And another major portion of the budget is expenses. And again, we have planned expenses and actual expenses. And finally, we have our profit or loss. And this is what we talk about when we talk about benefit. If we have a properly balanced budget, we should be resulting in a positive profit at the end of the month, which of course would be a benefit to us. So let's look at income. What are some common sources of income? Well, your paycheck as an employee, your pension if you receive a pension, retirement accounts or retirement, withdrawals from a retirement account. Also business income. But just a little note here, when it comes to business income, you want to make sure that you're not mixing your business accounts with your personal accounts. You want to keep your business accounting separate from your personal accounting. Although you may need to pay yourself from your business accounts, the overall business expenses should be kept separate from your personal expenses if you run a business. Let's talk a little bit about expenses. So you have what I call fixed expenses. And these expenses typically do not change from month to month at all. Common examples of fixed expenses are your rent or your mortgage. Typically that does not change from month to month. Car payments, home phone doesn't usually vary all that much. Your cable bill, your internet bill, your car insurance or other types of insurance premiums. Generally these types of expenses are fixed, meaning they don't change from month to month at all. The next category of expenses I want to talk about are required variable expenses. Now these are things that are required but with varying price yet fairly fixed quantities. In other words, the price may vary from time to time based on market conditions, but you buy fairly fixed quantities of this every month. For instance, some common required variable expenses would be things like gasoline. As we all know, the price of gasoline has been going up and down, and because it fluctuates so much, that's what makes it has that varying price element of our definition here. But it's required. You need it to be able to get back and forth to work. However, generally speaking, you probably purchase just about the same amount of gas every month, and so therefore the quantity is fairly fixed. Utilities, home heating and cooling, these are all kind of fall into this category, and you can probably think of some additional items which are required, meaning you need them for daily living, but they vary in price depending upon market conditions or other factors. Yet you buy them in generally about the same amount every month. So that's a summary of required variable expenses. Now let's talk about just plain variable expenses. These are required or they may be optional. And they vary in price and quantity with high personal discretion. So what are some common items that would be considered variable expenses? Well, things like groceries, movies, eating out. These are not necessarily required for daily living. Or if they are, you have high discretion in what you choose. For instance, when you go to the grocery store and you go to purchase your meat for the week, you could purchase all prime rib or you could purchase ground chuck. Depending on what you purchase will determine how much expense you incur. And so therefore, obviously the pricing between those two are extremely different, and you have the discretion to choose. And so these are things that we really want to monitor in our budget. So now when it comes to looking at our overall budget, we have our income and we have our expenses. And then, depending on the difference between those two, we come up with our budgeted profit or loss. So obviously, as we mentioned previously, our income is from our paychecks, our retirement, pensions, things like that. And if we add up all of that, and then we look at our expenses, and we add up all of our expenses for the month, and we subtract the expenses from our income, we will come up with our budgeted profit or loss. Now, a budget is a balanced budget when the profit equals the projected savings or the minimum, or at a minimum, the income is equal to the expenses. So let me state that again. A balanced budget is a budget where the profit is equal to the projected savings, or at a minimum, the income is equal to the expenses. In some cases, expenses may be more than income. If this is the case, the budget is not balanced, and it will begin to run a deficit. A deficit then must be covered by loans or other and over the long term will result in bankruptcy. So what is a monthly budget? Well, most personal budgets are constructed around the time frame of 1 month and should be monitored on a weekly basis. So you should check your income on a weekly basis as well as your expenses on a weekly basis. This is the best way to control your spending and to realize your income. Budgets should be closed at the end of each month with a comparison of budgeted and actual amounts for that month. So what we mean here is that we project our income in our planning for a budget, but our income may change. And if it changes, we need to know what we planned on having versus what we actually got in. And the same with the expenses. Let me give you an example. And here's an example of a monthly budget. As you can see, the husband's salary was about $3,000, was what was budgeted. The actual came in at $2,500, which meant that they had, when they closed their budget at the end of the month, they had a $500 difference. The wife's salary was budgeted at $2,000. The actual amount was $2,000, and so therefore there was no difference. But on the total income, combination of the two, because the husband's salary was $500 less than expected, they have a $500 difference between the two. And then when you look at some of the expenses in this category, you see rent is as it was budgeted, $1,200. The actual was $1,200. There was no difference. Food was $500. They actually spent $600. and therefore they were negative 100. With the car payment, however, they budgeted 500, it actually came in at 400, and there was a difference of positive 100. And so you can see here that while they budgeted for $2,800 profit, the actual profit was $2,300 because of the $500 difference in the husband's income. Let's talk a little bit about having a cash budget. A cash budget is intended to control spending because you only spend the amount of cash you have on hand. It's useful in controlling those variable expenses that we talked about, the ones that you have high discretion in. You should consider implementing a cash budget as one measure towards reducing bad debt. And consider leaving your credit cards at home. These are all just little tips. So if you take and utilize the cash budget, you look at all of your variable expenses, you add those up, and you decide to take out cash and use that cash as a means of controlling your spending by only using the cash to pay the variable expenses. And then when you've run out of cash, you're broke. You don't have any more money to spend, and you shouldn't spend any more money. Let's talk a little bit about an annual budget. After you've drafted a monthly budget, it becomes easy to construct an annual budget. Because for most items, all you have to do is simply multiply your monthly budgeted amount times 12. However, you may have some items such as car registrations that are paid annually. In these cases, you have two choices. You can annualize the expense, which means you can take that total amount and divide it by 12, and then keep that money set aside every month. Or you can just plan for it in the actual month that it's going to take place. And so those are a couple of good options for you. So let's review. We talked about income, expenses, fixed, required variable, and variable expenses, as well as a monthly and an annual budget. I hope this was all helpful to you. You can consider doing the budgeting exercise at any time you'd like. This will help you to put together your monthly budget. Thank you once again for taking time to take this class at MrWebProfessor.com.